Hello, everybody. Good evening. Today's last session in terms of transfer pricing. So we've covered quite a bit of it in the last session in terms of the pricing methodology and other aspects. So we will today largely focus on some of. We'll try to do some practice problem and also the fact that there are some procedural and other aspects which cannot be ignored, which are relevant and which are easy. I would say low hanging fruit. So if you have seen the last 2 days, as I mentioned to you in the beginning when we started transfer pricing, it is not a very technical subject, meaning it is not not much of legal provisions as such, but it is more business, more economic sense. So therefore, transfer pricing is more a practitioner's perspective of as I mentioned to you, chartered accountants can add a lot of value from a business perspective in terms of understanding the entire supply chain. So at the end of it, many of even the pricing methodologies are largely, math at the end of the day. If you're just able to understand one basic premise that my price, transfer price with my group entity should be equal to what a third party uncontrolled transactions would undertake, a related party would undertake. So, and if you're able to prove that arm's length, that is what we are trying to do. This is an anti-abuse provision. Please keep that in mind. So all we are trying to prove is whatever price I have charged, I have not undercharged, or whatever price my associate enterprise is charged has not overcharged. So if my associate enterprise is going to charge me, if they overcharge me, then I'm going to pay less tax in India. If I'm going to undercharge, I'm going to pay less tax. So the bottom line is you need to prove that depending on the transactions, you have neither overcharged nor your associated, you're neither undercharged nor your associated enterprise has overcharged. So if you're able to keep that in mind, I think the rest of it will just fall in place. So let's begin today's session. So what I will do is, I thought let's do some this can also act as a recap for our first two sessions, but also help in the sense of let's do some multiple choice question. I hope it's visible. Okay. So what I would want from you is, please keep answering, in the Q&A. I would want your participation as well. All right. Anyways, Lakshmikar, I got your question. Don't worry. It's very difficult for me to go through day one and day two sessions, but then I just gave a recap in terms of what transfer pricing is all about. Basically, you need to ensure that the transfer price is between group entities. And so therefore, any transactions in a multinational group setup, there's always a possibility of base erosion and profit shifting. I've already discussed what is base erosion and profit shifting, which is also there as a specific chapter. So we will also do that in one of my other sessions. So basically, transfer pricing facilitates base erosion and profit shifting. That is, you can erode your tax base by, as I mentioned to you, if you remember, instead of giving capital, you give debt. The group company gives debt, so therefore more interest cost, tax base, and similarly, shifting of profits between low tax jurisdictions. So then, in such a scenario, you will have profit shifting. So you'll have transfer pricing. So transfer pricing, basically, you need to ensure that there's always a possibility of avoiding taxes by arranging transactions between group entities. With globalization, a lot of multinational enterprises are present in India. So therefore, it's always easy, because they're under my control, I can always influence the pricing. So therefore, the tax authorities, administrators across the world have devised these transfer pricing provisions, which is called anti-avoidance provision, to ensure that people don't misuse or do transfer mispricing and thereby avoid taxes, which is what we saw in the last 2 days. Well, any case, I will just quickly run through again. The multiple choice questions is basically gives a kind of overview as what happened over the last 2 days. I also have today's session. Also, we will at the end of it, once we find time, I will also have cover those multiple choice questions as well. Because for the new syllabus, 30 marks MCQ and 70 marks non. So there is a possibility of transfer pricing coming in the MCQ as well. As I mentioned, to easily, consistently, especially if you see in the final new syllabus, last 2-3 attempts, 6 to 10 marks in transfer pricing. So in my view, low hanging fruit. I call it low hanging fruit because easy to take. Just grab those 10 marks. It will definitely help you for those who are aspiring to get rank, and even possibly help you in terms of your distribution of marks between groups as well. So very easy 10 marks on that for taking. Don't miss out. Now, first, yes, what does BEP stand for? I would also want answers coming in. So please do participate. So first one is very straightforward, sitter. I started off with an easy warm up. We've been discussing this, and we'll be discussing also, especially in international taxation, paper 6C and paper 7, international taxation. BEPS is the flavor. So there are a lot of BEPS mechanism introduced, governments across the world, since a lot of tax evasion is happening, tax avoidance is happening. Countries are trying to play very smart by introducing BEPS mechanism to plug all these tax loopholes. So base erosion and profit shifting, the first one is pretty simple. Second one, international transactions between two or more between two or more dash either or both of whom are non-resident. So what do you think will come into the box? International transaction means, now what is international transaction? Fundamental aspects of, very good. So the fundamental aspect of transfer pricing is this particular part. Any income arising from an international transaction shall be computed having regard to arm's length price. So there has to be an income or expense. It has to come from an international transaction. What is international transaction? International transaction means transaction between two or more dash either or both of whom are non-residents. So give your answers. We will discuss it. I want answers flowing in as well. 3. Validate this statement as true or false. An unrelated company is deemed to be an associated enterprise of a company A and is subject to transfer pricing regulations if a prior agreement exists between A's associated enterprise and third party in relation to services rendered by A to the third party. I repeat, I want you to mention whether it is true or false. An unrelated company, a third party company, is deemed to be an associated enterprise. So we saw in associated enterprise definition, there is a concept of deemed associated enterprise. This is larger than your Companies Act definition of related parties or your accounting standards. It includes any enterprise which has management, influence over pricing, where you are completely dependent on the other party. So all those things will also come under associated enterprise. There's one more deeming associated enterprise, which is, is a question. So I want you to answer whether it is true or false. An unrelated company is deemed to be an associated enterprise of a company A, provided if there's a prior agreement exists between A's AE and third party in relation to services rendered by A to third party. So the question here is, the transaction is between A and third party, which are basically two unrelated parties. So in such a situation, can this unrelated party be deemed as an associated enterprise, and therefore can this transaction be subject to transfer pricing is the statement. So I want you to let me know whether it is true or false. Fourth, what is the threshold limit for applicability of specified domestic transaction? So all these, if you recollect, international transaction, so there always has to be a non-resident. So transaction should be between two enterprises in multinational jurisdiction or multinational enterprise. So there may be situations where you may also have profit shifting happening in domestic situations. What are those situations? We saw the other day. Specified domestic transactions will be when a company, Indian company, also has a holiday unit. under 8, claiming tax holiday under 80 IA. So therefore, what will happen? They will try to shift more income there and take expense in the non-holiday unit, non-tax holiday unit. So therefore, there is a possibility of profit shifting. So therefore, specified domestic transaction was introduced for a very small limit of transactions. That is transaction between non-tax holiday units and tax holiday units within a group. Now, unlike international transaction is applicable even for 1 rupee. Even if I make a 1 lakh rupees transaction or a 15 lakhs transaction with my non-resident associated enterprise, international transfer pricing will come into picture. But however, for domestic transfer pricing, there is a threshold that is given. So I want you to answer, what is the threshold? That is, if you do specified domestic transaction up to certain amount, you will not come under transfer pricing purview. If you cross any of these threshold, whatever is your answer, I want you to tell me what is the answer. Then specified domestic transfer pricing will come, which is very similar to, you have to prove that the transfer price is at arm's length price. So this is with regards to question number 4. We are moving on to question number 5. The rate of TDS, this is 94 JA. If you remember, we discussed notified jurisdictional area, a concept where if a country does not cooperate with India in providing exchange of information, or it is a very notorious country, then India unilaterally introduced a section called section 94A, and they will notify that country. Once that country is notified, any transaction that an Indian company has with a company in that jurisdiction. So here it is jurisdiction. So if Cyprus was notified, of course now it's been withdrawn. So when an Indian company has a transaction with a Cypriot company, then even though the Cypriot companies will be a third party, let's say a Cyprus Bank of Cyprus, then by virtue of 94A, notified jurisdiction, since Cyprus was notified, any transaction you have with a taxpayer in that jurisdiction, that taxpayer is deemed to be your associate enterprise, and transfer pricing provisions will trigger. So this is basically they kind of a threatening message that either you, so what will happen? They're trying to deter Indian taxpayers from interacting with such taxpayers in those notorious countries. This is kind of India's way of saying, start being proper or cooperate. Now what happens? So transfer pricing will come. Not only that, they have also gone one more step and saying, if you are making any payment, TDS will have to be deducted. At what rates? Is the question for 94JA. Whether rates specified in income tax, rates in force under 2, clause 37A of the Income Tax Act, or 30%. Out of this, which should be whether lower of this, higher of this, median of this, or weighted average. So lower of the rate specified, or higher of the rate specified, or average, or weighted. I want your answer on 5A, on fifth question, straightforward. Let's go to 6. Any income arising from an international transaction? Again, very easy question. We have already discussed this. Any income, maybe for Lakshmikar, this is for you. Any income arising from an international transaction shall be computed having. So therefore, this is the premise of transfer pricing. The entire transfer pricing lies in this statement. So if there is an international, so let's take a foreign company, say Apple US with Apple India. So any transaction happening between Apple US and Apple India, the transaction can be anything: purchase of mobile phone, sale of goods, royalty, capital transaction, whatever it is, any international, which commercial transaction happening, that has to be at arm's, I've given the answer anyway, arm's length price. Now what is this arm's length price? Same thing what Apple India would have charged to a third party, or Apple US would have charged to a third party Indian customer, or between two unrelated parties. So it has to be at, to put it in a very loosely terms, it has to be in market price. But however, for transfer pricing, we use arm's length price. So it has to be at arm's length. So sixth is straightforward. Seventh, now how to compute this arm's length price? Arm's length price shall be determined by, so the legislation has given some methods. Okay, so you have to use those methods to arrive at the arm's length price. Arm's length price shall be determined by any of the 6 methods being, so what is that called? That is the method which you are going to take. So you can use any of the 6 methods, and that will be called as the most appropriate method, most accurate method, most responsible method, most adequate method. So basically it says the legislation uses one of these words, one of these answers, 7A or 7B or 7C, 7D, and says arm's length price shall be determined by any of the 6 methods, being the dash, being the most appropriate method, being the most accurate method, being the most responsible method, being the most adequate. I'm looking at that legal terminology. 8. I want more people to participate. I'm seeing some answers, very good answers coming in, but I want you all to give it a try, because this is where you can try. 8, same, true or false. I want you to validate the statement whether it is true or false. Comparability analysis is one of the major element of arm's length price. So now we have discussed this. I also gave already example Apple India, Apple US. So therefore, when transfer pricing is, especially arm's length price, one of the backbone, fulcrum, whatever you want to call, lies on comparability factor. So, which is called benchmarking. You benchmark yourself. Steven Smith benchmarks with Virat Kohli. Any cricketer would want to benchmark with Joe Root or Virat Kohli because they're the best. Same thing. So similarly, but you have to benchmark with Virat Kohli and Steven Smith. You cannot benchmark Virat Kohli with Michael Jordan. They may be sports person, but then it's a completely different sport, requires different talent, different skills altogether. Or a Roger Federer and Virat Kohli, because tennis is not a team sport. So therefore, even though they are world-class sports person, so therefore, transfer pricing also works that way. You have to benchmark. There has to be a comparability factor. That is how you will determine arm's length. So therefore, I already slightly indicated the answer also. Comparability analysis is one of the major elements of arm's length price, true or false. Cup method expansion, it is just acronym. I think we already did this as part of our first day acronym quiz which we did. Is it controlled unrelated price, comparable uncontrolled price, comparable unrelated price, cost undertaking price? So again, if you just look at the name itself, you can understand. I have to compare with what? Compare with uncontrolled transactions. If it is a controlled transaction, then it is not an arm's length. So therefore, I have to compare it with an uncontrolled transaction. So answer is very straightforward. Now, question number 10. Valuation reports, third-party expert reports, tender documents are valid proof to justify the transfer price at arm's length. Under which method? Is it cost plus method? Is it comparable uncontrolled, TNMM, or the 6th method? Which of these methods where you will use valuation reports, third-party expert reports, tender documents? So you based on these, you can justify that the transactions you have had with your associated enterprise is at arm's length price. Which method gives you this option? We discussed this as well in the last session. Now, last question before we move on to certain aspects for today. When there are more than one arm, okay, so no, so this is a question that we'll be doing today. Sorry, this question, 11th question, we'll do it after today's session. I want you to final question, true or false. Section 10AA exemption or chapter 6A deduction is available to the taxpayer in the case of transfer pricing adjustment. Just to elaborate, let's assume a taxpayer who is availing section 10AA exemption, export of software or article or thing, and he's doing transaction with his associate enterprise, parent entity or group entity or any associate enterprise, and the assessing officer finds out that the transfer price is not at arm's length. So there is a adjustment, primary adjustment happens. To that effect, the income gets increased. The Indian company does a sale transaction at 10 rupees. The transfer pricing officer says similar transaction is sold at 15 rupees. So therefore, there is this 5 rupees adjustment is done. And once this 5 rupees adjustment is done, obviously, when you do this 5 rupees adjustment, then your income goes up. You have to pay consequential tax. Now, the Indian company's contention is, I am availing section 10AA exemption. So that the transfer pricing adjustment of 5 rupees from 10 to 15, I am eligible to claim section 10AA. Or if it is a section chapter 680 IA series, it says I want to claim it because you are showing this as income, I am eligible. It says it is available. I want you to know whether it is true or false. I'm good to see some very good participation. So anyways, now keep participating like this. Because since I don't see you guys, it'll give me some sort of a comfort that there's some interaction happening. So second, let's discuss the answer. First, I've already indicated the answer, base erosion, profit shifting. Second, international transactions means transactions between two or more associated enterprise, either or both of whom are non-residents. So who will be an associate enterprise? Management, control, influence, all these will come under associate enterprise. So any company which has a management control, that is, they're able to appoint board of directors, they may not hold any capital, but by virtue of management, they can still do it. So they will come as associate enterprise. Very widely defined, so you can look at it. Third, an unrelated company is deemed to be an associated enterprise of a company A and subject to TP regulations. So therefore, the answer to this is true. If you recollect, this is the deemed associated enterprise concept. So therefore, this is what we discussed, if you recollect. Prior agreement. So A is parent and third party. This is very common in multinational. I'm sure you would have come across in your audits or those who have done transfer pricing in your internship, articleship. Normally there'll be a procurement organization. Why? Very easy. One organization will only be a global procurement organization. They'll talk to vendors across the world and buy raw materials or inventory for the group at a lesser cost because bulk order. So therefore, multinationals try to use these synergies. So they'll go locate themselves in a place where there is no VAT or less customs duty, very good free trade agreement, where you can import freely, tariffs are less. So what they will try to do is they'll try to find out those locations and then set up a shop there or entity there. That entity will do a global procurement and then they will say, go supply it. So they'll order and then, but the supply will happen. They will say to the third party, go and supply this to my Indian subsidiary, go supply this to my Bangladesh subsidiary or my Pakistan group company. The thing is, the parent or the associate enterprise already influence those transactions. So therefore, even though by virtue of this influence, transaction between A Limited and third party, even though it is between two unrelated parties, it will be treated as a deemed associated enterprise. So the statement is true. Fourth, what is the threshold? The threshold is 20 crores. The threshold is 20 crores. So therefore, this is the answer. 20 crores will be the threshold. So up to 20 crores, no transfer pricing, no domestic transfer pricing, no domestic transfer pricing. So beyond 20 crores, so any transaction between group entities in a tax holiday, non-tax holiday unit, the limit is 20 crores. Now moving on, this we already discussed 94A, it is higher. So they want to penalize. So therefore it is higher. So normally royalty or fees for technical services rate will be 10%, but by virtue of being located in a non-notified jurisdictional area, 94A, the TDS will be at 30%. So therefore, it is higher. So fifth will be higher. Now, with regards to the next one, sixth question, any income arising from an international transaction? Yes, straightforward, arm's length price. So you all know the answer. Seventh, arm's length price shall be determined by any of the six methods being the most appropriate method, MAM. Most appropriate. So the terms used is appropriate. Should be appropriate method. It cannot be accurate. Why it cannot be accurate? In transfer pricing, very difficult to get accurate. Unless and until both the companies are very same, you have to get the exact comparable. Even if they're exact comparable, you know, even though we say Oppo or Vivo are, you know, more or less in the same category, but they have some unique features there. You know, OnePlus and has a certain unique feature. Apple has certain. So even assuming you say both are end of the day, you know, more feature, but there will be some factor which will be their functional may be different, their pricing volume will be different. So therefore, the term used is most appropriate method. So the most appropriate method is the right answer. Comparability analysis, yes, we have discussed a lot. Transfer, especially arm's length pricing, works on comparability, benchmarking. 9, cup, I have already discussed. Comparable uncontrolled price is the answer. 8 is true. 9th is B. 10th, this is the sixth method, valuation report, third party. This was recently introduced in India few years back. The reason is many cases it was very difficult to find the comparability and a lot of litigations were happening and some transactions very difficult to compare. As you know, if you recollect, one of the examples we did in sixth method was we did a where a patent valuation happened. So if you recollect, a patent valuation happened. So how can you compare a patent valuation? Because patent itself is unique. You cannot compare with similar patent. If similar patent is there, then that's a violation. So patent is itself unique. So therefore, in such a scenario, the valuation from a valuer will help the company to show that it is a transfer pricing. Now, sixth method, last 12th, section 10AA exemption or chapter 6A deduction is available to taxpayer. Answer is false because this is an anti-avoidance. Once there is a transfer pricing adjustment is done, which means you have either underpriced or overpriced, depending upon the transaction. You have avoided tax in India. The government says, the first instance, you have done some jugglery. Why should I give you? So therefore, for transfer pricing adjustments, you cannot get section 10AA exemption or chapter 6A deduction. So this is what we did. So this is the multiple. So we'll continue if time permits on today's session so that we'll have a complete overview of multiple choice questions with regards to transfer pricing. Now, before I move on to do some, practice exercise today and also go into today's session. So we'll be focusing on secondary adjustment and a few other, these complaints aspects like how the assessment procedure works, what are the dispute resolution prevention. But before I go to it, last class, we discussed about PE. That is very, very essential. I want you to, for those who are already familiar, well and good. Permanent establishment is an international taxation concept, a fiction introduced globally, which is now followed in Indian domestic also. It's a global concept whereby a foreign company. So let's take a situation for you to easily understand. This will help you for our Saturday session on equalization levy. Netflix, I'm sure many of you during this lockdown would have subscribed for Netflix. Now, Netflix, of course, now has an Indian entity. It's a very recent phenomena. But till 2018, they never had any entity in India. They were, if you have subscribed for Netflix in 2018-17, the bill would have come from Netflix USA or Netflix Ireland. Now, Netflix didn't have any office in India, but let's assume Netflix sets up a branch office. They set up a branch office and does marketing, other activities. They want to bring more users from India. India is a good market. A lot of people watch movies. India is very movie centric, or people are passionate about cinemas. So they set up a branch office. Now, what they will do is, we all know branch and head office are one and the same person. They don't have a legal status. So Netflix USA has a branch in India. So in order to these companies in India, so when the branch office in India will not pay any tax in India, they will say, no, I'm not a separate person at all. So therefore, the permanent establishment concept came in international taxation. Thereby, the PE is given a deeming fiction as a separate person. So therefore, the branch office will be treated as a permanent establishment. It is treated as a separate person fiction for tax purposes. And therefore, the branch office, whatever profits that it is earned from India, it has to pay tax in India. So this is a method to connect nexus to a country, to basically to bring source. To create income is tax either on accrual, receipt basis or on source basis. So to show the source is in India, if there is a PE in India and any profit is made from that PE, then source is in India. So India will say pay taxes. So therefore, PE is a concept to thereby create a economic nexus in source country. So we saw PE will also become an associated enterprise. The concept of PE will help you not only for transfer pricing, will help you for other international taxation and even for your paper 6C, because the international taxation majorly revolves around the issue of permanent establishment. So we saw international transaction must be at arm's length price, and how to determine arm's length price, the methods. So the methods we saw were 5-6 method, the comparable uncontrolled price method. You just have to compare it. So we also looked into resale price method. Just one particular point which I wanted to bring to your attention. If you remember the resale price method, we solved a problem. That actually I realized, my apologies for this. The question, there's a small change in the question. I just realized it post last class that I just swapped it. Anyway, so this is the question. Assault Corp France and Sunil Company are associated enterprise. See, it's all math at the end of the day. Sunil Company imports 3,000 engine at 7,500 per unit. It's sold to Indian customer at 11,000 per unit. So therefore, this is the related party transaction. That is 30 engines at 3,000 engine at 7,500. So I got from my associated enterprise. So this transaction is what we are going to focus on. I've sold to an unrelated party for 11,000. Thankfully, Sunil also imported from HAL, an unrelated party. So this will be very easy for us, because we can do an internal comparison and find out whether this is at arm's length. And he sold for a gross profit margin of 20% on sales. Since he is a distributor, so on gross profit, he has 20% on sales. Now, apart from this, there are some adjustments that you need to keep in mind. HAL, unrelated party, offered a discount of 1,500. Group company, that is Assault, offered only 500 per unit. So which means my unrelated party has given me more discount. My related party has given me less discount. And then my freight cost from group company is very high. Freight cost from unrelated party is only 200. So determine the ALP and amount of increase in Sunil. So we need to find out whether this is at arm's length. So what is it? Resale price method to Indian customer. So you can start from the uncontrolled transaction. That is, he has sold it to a Unrelated party for 11,000. We need to find out what? We need to find out what is the cost of import. And whether the cost of import of 7,500, whether it is at arm's length is what we need to find out. Now, starting will be my resale price. So this is what I have sold to my customer 11,000. The question said there's a 20%. So he makes a 20% on gross profit. So we can keep gross profit of 20% as his arm's length gross profit margin. So therefore, 20% gross profit margin, you have to deduct it. We are trying to find out the cost of goods sold. So 11,000 minus 2,200. So ideally speaking, 8,800 is what you will feel his cost of goods sold will be. But then the question goes one step, two adjustments. One adjustment is my apologies. I just now I saw that the question screen is not shared. I was in this particular. So this is what I hope the screen is visible now. Yeah, okay. Then these are the problem with technology. You assume we thought, okay. Anyways, my apologies for this. So what I was trying to say is, this is a question which we already did in the last session. Sunil imports 3,000 engine at 7,500, sold to Indian customer at 11,000. He also imported similar products from HAL at 20% on sales. Now, small correction from the last session, which is why I'm discussing this. Hey, actually, it's unrelated party had offered me more discount, and related party, my related party or associated enterprise, offered only 500. So there's a freight cost of 1,200 and freight cost from unrelated party is only 200. Now we need to find out whether this 7,500, because this is my cost. When I mean mine, the Indian AE's cost, because he has imported. This is his cost of goods sold. He has imported this. So now we need to find out whether this 7,500 is it right? Has he paid extra? Had he paid extra, then what will happen? Indian company, if he pays more to his AE, more expenses, so less profit. So we need to find out what is the arm's length price. What should be the ideal cost for import of these engines? So we will see the answer here. All right. So I start off with 11,000, which is what I sell to a third party. The question specifically gave that there is a 20% on sales. So therefore, my gross profit margin, even for unrelated parties, is I keep 20% on sales. So 20% on sales, 11,000, 2,200. So 8,800, you will assume this is his cost of goods sold. But the question also says there are additional expenses he has incurred. That is, HAL has offered discount of 1,500, but my group company, my associated enterprise, has given me only 500. So which means I have paid extra to my group entity. I have paid extra to my group entity, 1,000 rupees. That needs to be adjusted. So this is that adjustment. Incremental quantity discount, I have paid extra. So on this 8,800, I have to deduct this. Similarly, freight, I have paid 1,200. But for HAL, 200. Ideally, I should have paid 200 only from an unrelated party. But since I'm importing from AE, I have paid extra. So therefore, this difference of 1,000, 1,200, that also has to be reduced. That is what we have done here. So therefore, 11,000 minus my gross profit margin minus incremental amount I have paid extra. So I need to reduce that. 1,000. Similarly, I paid freight extra. I need to reduce that. And my arm's length price cost of goods will come to 6,800. So 6,800 is what I should have imported from my associated enterprise. But how much have I imported the engine for? I have imported the engine for 7,500. I have imported for 7,500. So which means I have paid extra 700 rupees. So I have to make this adjustment. Total 3,000 units. My income will increase to 21 lakhs. So this is, so if you see here, all you need to do is when you get a transfer pricing question in exam, don't panic, because as I mentioned to you, it has nothing to do with much of a technical. These are all your extension of your paper 5. What I did is pure costing. I'm not talking about any provision, any section. So therefore, for a moment, think, okay, gross profit margin 20%, it's sold to a third party 11,000. So we need to find out. So what is that we are testing here? The transfer price. What is the transfer price? Transfer price is the 7,500 from associated enterprise to foreign AE to Indian AE. Now I need to ensure that since Indian company has paid 7,500, whether is it at arm's length? Have I paid more to my related party is what I need to check. So we did this exercise. We found out that he charges 20% gross profit because he's a distributor. So any sales will always happen to a unrelated party. So we've reduced it. So we only tried to find out what is the cost of goods sold. So we removed all incremental payments. Finally, we figured out that the arm's length price is 6,800. What is the price? So I should have bought it for 6,800, but whereas I have bought it for 7,500, and hence adjustment to be made. My income to that effect has to be increased because I have booked extra expenses. Now I need to do, which is what I have done. This is transfer pricing from a resale price method. So this I wanted to bring to your attention because I just realized that I have I swapped this thing. So I hope it is clear. But as I mentioned to you, so most likely they will test on a comparable uncontrolled price method largely. So now moving on, I just want to solve a couple of problems on transaction net margin method. Don't worry about profit split. So these are all just methods. You can just have a look at it. But I doubt whether you will have any question on how to go about with the methods. Comparable uncontrolled price and transaction net margin method are the commonly used methods in India practically. Now, what is transactional net margin? The only difference compared to the cup or retail price method, here we focus on the net margin, operating margin. So we don't look on the transaction wise, we look at the final operating margin. Why we look at the final operating margin? Because of product comparability is less here. I don't need to go transaction wise. I only have to ensure whether my profit margin. So this method is widely used because they only want to ensure that my margin, my final operating profit margin is what similar comparable companies are charging. So this is only testing at the margins level. So therefore, this is widely used. If you recollect, we saw this example. This tested party is my associated enterprise. So here, let's assume I'll repeat the example. Let's assume I'm McDonald's and I do transaction with group company. My operating margin is 4%. Comparable KFC, Haldiram's, Starbucks, Dunkin' Donuts. So 2% Dunkin' Donuts charges, 3% is Starbucks operating margin, Haldiram's 4%, KFC 6%. Now, if you see, functionally very difficult to compare each because McDonald's has its own people, go for their burgers, softy, whatever you want. KFC has a completely different, for the buckets. Haldiram has a different flavor.
Starbucks people go for the coffee and other thing. Dunkin similarly. So even though broadly they're in the same industry, functionally different. So therefore you cannot do a comparable uncontrolled price or a resale price method. So therefore, I'll come back to your question, Deepa. So therefore, what we do is we do a operating profit margin reduction, so operating profit comparables, and then try to find out whether my operating profit margin. So this is very easy because all I have to do is finally whether my operating profit margin is comparable. So here 4%. So my comparable company shows in this range. Now, how to determine operating profit margin? This is called profit level indicator. So it can be operating profit by sales, or it can also be operating profit by cost. Now, how will you take the denominator? Denominator should always be untainted, meaning if I am selling it sales to AE, if I am making a sales to my AE, then what is untainted? Sorry for the handwriting. Untainted is the cost, because the cost is in my control. I'll incur cost, but my selling price will be probably influence of my AE will be there. Similarly, purchase from AE. Then what is untainted here? Untainted is the sales, because this purchase cost of goods sold, he determines, give it at 7,000, pay me 7,500. But I can always sell it at 20% gross profit margin or 30%. So therefore, if you're purchasing from AE, then your PLA should be operating profit by the untainted, so which will be sales here. In this sales way, your operating profit by cost. So you always have to decide based on the transaction, and the denominator of the PLA should always be untainted. So which means uncontrolled. The associate enterprise should not have any influence. So this is easy way to remember. So this is what transactional net margin. We also did a problem. Just this company AE1 sells it to AE2. So it sells it to associated enterprise. So therefore, there is a sale transaction, sales, which means when you do a PLI, it should be operating profit by operating cost, because your cost is untainted. The cost is in your control. Your sale price will maybe influenced by your associated enterprise. So now coming back to this question, they found out that this J Limited, some third party, is my comparable. So therefore, we need to find out whether the operating margin, whether the transfer price of AE1 and AE2 is equal to arm's length price. If not, adjustment will be made. How to find out? Let's go here. We did this. I'm again doing it. So this is the one here. So what we need to find out is that there's a sales of 130, operating expenses 85, profit bid. So we should only take operating cost. Don't take interest. One question that may come up with is whether depreciation, whether can depreciation be taken. Unfortunately, in India, there are divergent views. One school of thought says depreciation is an operating item. Another school says depreciation is not an operating item. So ideally at the exam level, I will not ask any depreciation to avoid controversy. But if in case depreciation is given, you can give a note assuming it is not part of operating expenses, or include it and say you are considering it as an operating item. Anyway, so what I have done is to make your life easy. I have not given depreciation. I have only given interest paid. We have to ignore interest because interest is a finance cost and not a operating cost. So coming back, we need to find out the operating profit margin of AE1. What is the operating profit margin? Operating profit divided by untainted denominator. Your cost because you're selling it. So operating profit by operating cost. 45 divided by 85. Look here, 45 divided by 85 is what I have done in the formula. So 45 divided. So therefore, operating margin of AE1 is 53%. Now let's find out what is the third party's operating margin. Third party here is J Limited. So we have J Limited's cost. Sales is given, everything is given. 200, 120, and profit before interest is 80. I have also not included the 10 here because this is interest paid. So this is only to confuse you. So I have not taken it. My profit before interest will be 200 minus 120, 80. So what is my, when I mean, what is the unrelated party's operating profit margin? That will be operating profit by operating cost, 80 divided by 120, which is 67%. So therefore, 67% is what the third party's operating profit margin is. Now, I have to do a arm's length price adjustment. How will I have to do my operating expenses? I'm AE1 here. So this is, so when I do an TP adjustment, operating expenses 85, add ALP margin. So therefore, the margin I should have charged to my associate enterprise should be 67% and not 53%, because a similar comparable uncontrolled entity which I have picked as my comparable J Limited has an operating margin of 67%. I have only shown 53. So therefore, my arm's length margin should be on my operating expenses 67%. So my sales price should have been 142. But what is my sales price? Only 130. So the difference 12 will be the transfer pricing adjustment. This is called the primary adjustment. So the assessing officer will make an adjustment and he will increase my income from 130 to 142, and accordingly for this 12, whatever is the tax payable, he will send me a demand and I have to pay that. So this is what transactional net margin method is. Now I want you guys to, so all you could have seen is it's all at the end of the day mathematics. So and I'm not done something new. So one moment. Okay, I want you guys to, try this problem. This is from your exam. I mean, I don't. I think this is from the May 2019 attempt. Yeah, this question. Anyways, I think what I've done is I hope the screen is visible. Yeah, okay. So this is the question. So this is a 6 marks question, May 2019. I want you to give it a try. Just very similar approach to what we did for the previous problem between A Limited and J Limited. So I'll give you 5 minutes time. 6 marks easy on there for taking. So first, step 1, find out whether they are associated enterprises. We saw who could be associated enterprise. Here there's a loan given. So see whether that 51% of book value, that is what they are trying to test here. And then find out the operating margin of the taxpayer, which is Beta Inc. and Beta Limited. Find out the Beta Limited's operating margin. Find out the unrelated parties operating margin and see if there is any adjustment to be made. So transactional net margin method, so which means operating margin. If you see here, cost is given. So therefore here it is very easy for the third party. Obviously, because operating profit by operating cost, because that is the untainted. So that is why third party's cost is given. So I'll give you exactly 6 minutes. This is a past examination question. Give it a try and also let me know what is the arm's length margin you are getting. What is the unrelated parties margin? Please try. Give it a shot. You will find out that all you have to do is common sense, the commercial sense. I hope you guys have find out the arm's length price. If you have done, please share your answer as well. I see answers from Irshad, Preeti, Ambika. Very good. Glad you guys are trying it. Comparable 33.33 says Irshad. Sales price should have been 93.75 instead of 90.75. 7 lakh it's to be added to income of beta. Any further answers? I'll give you 2 more minutes. So your approach should be find out the first operating margin for Beta Limited in Beta Inc. transaction. Then find out the operating margin of Gamma to Olive, which is a comparable uncontrolled transaction. Find out their margin. And then once you find out the unrelated parties margin, now you need to, if you find the transfer price margin between beta is less than the arm's length margin, you have to make necessary adjustments. Can I get some more answers, please? Or at least give me the margins. What is the operating margin for beta, and what is the operating margin of gamma? Okay. All right then. So let's go and solve the problem. So I've already mentioned to you that first thing we need to do is find out the operating margin. Hope my screen is visible. Yeah. So first, let's find out the, okay, but before that, the question, I'm sure many of you would have got the first part. Beta Limited 125 lakhs book value. So loan, if you multiply 160,000 with the Singapore dollars 45, then the loan amount will come to, or the book value, loan versus book value will come to 57%. So which is more than 51%. So if you recollect the deemed associated enterprise, one of our first session we did this. Loan is greater than 51% of total assets. So therefore, you become an associated enterprise. So therefore, by virtue of this, they are associated enterprise. So, and is there an international transaction? Yes, the transaction is software related. So this is a normal services transaction. So therefore, international transaction between associated enterprise. Now we need to see whether this is at arm's length. That is what we are trying to find out here. Whether it is at arm's length. So let's first find out the operating margin. So the question says the billing per hour. So they have given you billing per hour of 75 per man hour is the cost, and it is billed at 90.75. So therefore, what I'm done is I'm trying to find out the operating margin per hour. So which is 90.75 into 45. 45 is your Singapore dollar Indian currency. So my billing per hour in INR will work out to 4,083. What is my cost per hour? Cost per hour is given here. The cost for Beta Limited is 75 per hour. So therefore, what I do here is 75 into 45. So my operating profit will work out to 4,083 minus my billing minus cost. So 708 is my operating profit. So my operating profit divided by operating cost, 21% is my margin. When I mean my margin, it is the margin of Beta Limited. We are testing whether the transfer price of Beta Limited is at arm's length. So 21% is step 1. I saw Rishad getting it right. Now let's move on. So we have found the operating margin of Beta. Now let's time to find out the operating margin of the uncontrolled transaction. The question says Gamma Limited and Olive, which are unrelated party, their transaction. Direct cost is at 600, indirect cost 200, operating profit is at 200. So all we need to find out is we have the relevant information for computing the margin. Just taking then and again so the screen is visible. So my direct cost as given in the question 600, my indirect I keep saying I'm sorry. The indirect cost of the third uncontrolled transaction is 200. So the total cost works out to total operating cost works out to 800. They have given that the operating profit is 200. So operating profit is 200. So very easy to find out the margin. Operating profit by operating cost. So 25% is the arm's length margin. TP margin 21. So therefore, my transfer pricing margin is less than my arm's length margin. Therefore, it requires a clear adjustment. Now, just to complete the formality, what is that the amount to be adjusted? Now, you saw what is my cost per hour. We found out the cost per hour. 75 into 45, 3,375. That is my cost per hour. All I have to do is add 25% margin to it. So I should have billed 4,218. That is my cost per hour plus 25% margin. The arm's length price I should have charged is 4,218. What is that I have charged? You can find out here. The amount I have charged is 90.75 into 45 into 50,000. See, this I'm just trying to bring it into whole 50,000 hours. So it comes to 20 crores. My arm's length price works up to 21 crores. So 67 lakh 50,000 is the exact adjustment to be made. Arm's length adjustment to be made to the total income of Beta Limited is 67 lakh 50,000. I don't know how you guys, I see. Okay, let's try to solve this. 7,87,500, no Ambika. So the amount to be added is 67,50,000. This is the final amount to be added. I will repeat again. I hope you're all clear with the operating margins. 21%, 25%. Now, all I've done after that is, I found the answers. I'm just a puzzle. I'm just putting everything back to its pieces. So my cost per hour, I've been charging 3,370. We found out here. 75 into 45. 3,375 is my cost. My profit on that 25%. This is what I should have billed them. I should have billed them 4,218.75. Look here, what does I have billed them? I have billed them only 4,083. So I should have instead built them 4,218. So 4,218 into 50,000. Here, my existing building, this part, 4,083 into 50,000. The difference is my adjustment. Other way to bring this adjustment is 4,02,018 minus, as I told you, it's all pure max what we are doing, no rocket science. Into 50,000. So the difference between my transfer price, my arm's length price and transfer price, 50,000 is basically the man hours. That is the total man hours. Spent 50,000. So therefore, I've just brought it into a conclusion. So therefore, 67 lakh 50,000. Correct. Cost is controlled. So we are here. Actually, cost is uncontrolled. Preeti, cost is uncontrolled. So we are, see, now what we are doing, we are concerned about the sale price. Look from an Indian tax administrator perspective. What are you concerned here? If you are a tax authority, you are concerned about what? There is a sale transaction that has happened from Beta Inc. to Beta India to Beta Inc. So Beta India should have billed more. More they bill, more revenue, more profit, more tax in India. So what I will do as a tax authority is, I want to ensure that the Beta India has billed Beta Inc., its associated enterprise, the amount which third party would have also done. So we found out that third party charges 4,218.75 per hour. What is that I am charging? 4,083.75. So the tax officer now feels, okay, this guy has smartly done transfer pricing, price away, mispricing. He should have charged 4,218, but he has charged only 4,083. So difference I am going to add it. So this is transfer pricing. And so therefore now he will add 67 lakh 50,000 in Beta India's total income. To that effect, tax has to be paid by Beta India. This is transfer pricing. So I'll take up the questions. So this is the maximum they can test you. So all you need to know is at the point in time at the exam, just keep calm headed, find out what is my operating margin. When I mean the taxpayer's operating margin, what is the third party's operating margin? Whether it is, if for example, very simple. For example, here, if this margin is 30%, no adjustment is required, because I have charged more than what an unrelated party has charged. So therefore, no transfer pricing adjustment. Everybody is happy. Especially income tax authorities are happy. I have a couple of questions here. I'll answer them. But in the meanwhile, if you have any questions, please get it clarified from your head, so that 6 marks easy for taking without even remembering any provisions. All you need to do is mathematics. Use your calculator to good effect. So comparable, I see 33.33. No, I don't know how 33.33. I see Irshad as well as I saw somebody else also have mentioned it as 33. Rohita. I'm not sure how both of you got. Okay. All right. Irshad and Rohit has done the same mistake. Indirect cost. See, look, indirect cost is very much part of your operating cost. Operating cost will what and all? That will be direct cost. That will be indirect. What is your direct cost? Your cost of goods sales. We are talking about transaction net margin method. So unlike your resale price method, where we were concerned only about gross profit, here we are concerned about net margin. I only said you cannot take non-operating. I never said indirect cost. So operating expenses will have direct cost, which is your cost of goods sold, directly related. What is indirect? It can be office expenses, administration expenses, selling and goods expenses, where you cannot directly attribute it to the product or service. So, but they are very much part of operating. Please don't confuse indirect cost. Indirect cost, direct cost. your costing fundamental. They're very much part of your operating expenses. Non-operating expenses are your finance cost, interest and all those things. That's why you call EBITDA, earnings before interest, tax, depreciation. Why? Because we want to know what is your operating profit. So depreciation is only a question mark. Whether depreciation, some tribunals in India have said depreciation is an operating item. Some tribunals have said depreciation is not operating item. So therefore, there is a gray area. But anyways, because of this, I don't think they'll test you at the exam. So, but you don't need to worry. So all you need to worry is whether it is a finance. So if it is a if it's interest here, then you should not include. So Irshad, Rohita, that way I think you, Preeti have answered. Neha, very good. Gamma is 25%. Billing amount should be 93.75. Maybe. I'm not converted into SGD. Okay. Clear? So this is what, this is 6 marks, up for grabs. Don't miss it out. Now, one aspect before we move out of arm's length pricing, which is again a very important concept. Not sure why it's not visible. Preeti has asked a question, just looking at it. If we increase cost, our profit will reduce. Yes, if we increase cost, our profit will reduce. So we need to bring profit up of beta limiter and we need to increase sales price. That is what we have done, Preeti. So what we have done here is, we have not touched anything about the cost. I showed you, see, I think you got confused maybe because of this part. What I've shown, this is the cost that we have charged, 3,375. Beta limited has charged 3,375. I got this from here, cost per hour. That is my $75 per hour is my cost. So I put the cost. I have only said your margin should be 25% because Gamma charges a margin of 25%. So therefore, you should have charged 4,218, which should have been your selling price, which should have been your billing per hour. You should have billed 4,218.75. But how much have you billed actually? You have billed only 4,083. So therefore, the difference between 4,218 and this is your adjustment. That is 135. Now this is 50,000 man hours. So you put 50,000, you will come to 67,50,000. I hope it is clear now, Preeti. So we are only concerned about, see, income tax is now concerned only, the department, revenue authorities are concerned only about increasing your sale price. They are not bothered about your cost. When will they be bothered about your cost? It is the other way around. That is, you buy from your associate enterprise. Here you are not buying from your associate enterprise. You are only selling it to him. So therefore, they are now concerned about your sale price. So they want to increase as much as it is possible. So more profit, more tax in India. Similarly, if you're in case you're buying it from him, they will try to ensure that your buying cost is lesser. So if your buying cost is lesser, your expenses is less, more profit, more tax. So this is, I hope it is clear, Preeti. I'm not sure where you're stuck. Let me know if you still have any doubt. All right. Now, one last aspect in arm's length price I don't know why it's not visible here. Anyway, so now, if you recollect this example, so now in both these examples which we did, we have one comparable company, one comparable transaction is arm's length. For Gamma, 25%. We also saw here J Limited 62%. So one comparable. What if there are multiple arm's length price? So we discussed this in the last session as well, which we will be discussing further today. So what if I have so if you see, so why I am unable to delete this? So now if you see this example that is in front of you, okay, I don't know what it is. I'm unable to. So now if you see here, 2%, 3%, 4%, 6%. My transfer price margin is 4% here. This is mine. It is 4%. Comparable A 2%, comparable 3, 4%. Now which one will you choose as arm's length price? If you are given a choice, what will you choose? Can you mention your answer here? If you are given a choice of comparable A, B, C, D, which one will you choose as your arm's length price? Give me your answers, please. Whether will you choose comparable A, will you choose comparable B, will you choose comparable C, will you choose comparability? Now you have 4 arm's length prices. Now given an option to you, which one will you go for? Which one will you choose as your margin is 4%? Can I get some answer? And also, if you are the tax authority, which of these comparable will you go for? So role play. 2 answers I need from you. 1, if you are the taxpayer, which of the comparable you will choose? If you are the tax administrator, which of the comparable you will choose? So can I get some answers, please? Rohita says comparability. So if you are a taxpayer, you will opt for comparable A as my arm's length price, because comparable A charges only 2% margin. I am charging 4% margin. So I will tell tax officer, look, he is charging only 2%. Uncontrolled third party arm's length, but whereas I am charging 4, my margin is more than, my transfer price is greater than arm's length price. So no adjustment to be made. But on the other hand, if I am the tax administrator, I will say comparable D is your arm's length price, he is your perfect match, because he will say, look, he is charging 6%. Why are you charging only 4%? I am going to make adjustment 2%. Preeti, your answer is right, but you're opposite. As a taxpayer, I will choose. Correct. Oh, sorry, you're right. Preeti, you're right. As a taxpayer, 2%. As tax administrator, I will go for 6%. So this is what I will do as a tax administrator. So if I am a tax administrator, I will go for this. So tax administrator will go for this. If I am a taxpayer, I'll go for this. So this is a problem now, especially in TNMM. So this is what we call it as. So what a lot of taxpayers were doing is, they'll do something called, normal English word, cherry picking. this not only taxpayer, even tax administrator will do, tax officer, TPO will do. They will accordingly select comparables so that to whomsoever convenience it will come. So this is an issue, especially when you have multiple arm's length price. So when you have multiple arm's length price, that is multiple comparables, so you will be an issue as to which one will you go for. So therefore, to solve this conundrum, to solve this issue, look here, I hope the screen is visible. So to solve this issue, under the Income Tax Act, if there is only one comparable, then you can always use that as your arm's length price. We saw in the two examples which we did, we had only one comparable, gamma, one comparable, in another case, J limited. So no problem, very easy, life is easy. I just have to compare my transfer price with my arm's length price. But when I have multiple comparables, like what we saw in the KFC McDonald's case, then the income tax legislation, by virtue of the rule 10CA, gives an option called range. So whereby you can use a range. This is again from max, we are slightly moving now to statistics. So this is something which you have done in your CPT or in your 12th standard or school range. So they are saying use the range scenario. So we are when you have multiple this thing, they're saying you can go for a range and pick and accordingly determine your comparable. So that is what we are going to see now finally, where whenever I have multiple comparable, this is what, so we are going to look at range. Now range was introduced because of these issues which I explained, cherry picking and people. So range can be used in these methods when there is CUP, RPM, CPM, TNMM, all these involves comparables. So when these four methods are there, when you use these methods and when you get multiple comparables, so multiple arm's length price, more than one arm's length price, you can use range. One more aspect for using range is there should be 6 or more comparable companies. So when you have only 3 or 4, you cannot use range. What will happen then? I will tell you later. But one of the conditions to have a range is you should have 6 or more companies. This is very common. You will get 6 or more comparable companies in IT, ITES sector, KPOs, BPO, automobile, manufacturing. So in those scenarios, it is very, because India does all these activities very, so there, a lot of activities happen. So therefore, one of the conditions is 6 or more comparable companies. And once you have 6 or more comparable companies, we'll do a problem for better understanding. The arm's length price, the range, if you remember your statistics, measures of dispersion. Why do you do dispersion of data? To find out the range and scale. You have the central median, mean, median, mode, quartile deviation, percentile. So all these things are scales of measure, along with the scales of measurements you use to classify the data. So here what they are saying is, when you have 6 or more comparable companies as your data set, then your arm's length price will be in a range. The range will be between 35th to 65th percentile of data values, statistics, percentile. This is not interquartile. Interquartile is what? Divided by 4, 25% to 75%. Here, don't ask me why 35 to 65. Globally, some countries use interquartile range. Some countries use only arithmetic mean. Get all the comparable companies, do a arithmetic mean. But India has gone for 35th. So interquartile will come to 25th to 25 to 75. So range will be higher. But India has gone for a slightly conservative 35th to 65th percentile. So if the arm's length margin is not between the 35 to 65, then you have to make transfer pricing adjustment. We'll solve a problem for you to easily understand. So this, again I repeat, you will have to do this range concept when you have multiple comparables, multiple arm's length price. And now one of the conditions for using range is it can only be used if you use CUP, TNMM methods, RPM, and control cost plus method. So profit split method alone is excluded. So when you use these major 4 methods, CUP and TNMM are very commonly used, and minimum 6 sets. So look at the example before you for better understanding. So there are 7 comparables you have found: A, B, C, D, E, F, and G. Now these are the operating margins that is in front of you. So A has an operating margin of 12, B this, C this, D, G has 10.5. Now, which one will you choose? So this is a issue we saw. Whether 8 is my margin or how should I benchmark my transfer price? So this is an issue. So what the income tax section 92 CA read with rule 10 CA says you can now go for, previously what would have happened is I would have taken a weighted average mean. Now you tell me weighted average mean, you mean always has some, here if I take a mean, this may give a very completely different number. So sometimes mean is not used when you have, widely fluctuating margin, widely fluctuating numbers. So that's where you go to median. Mode is used for qualitative characters. So here mean was used previously in India, but many were unhappy with the mean because they felt it was very mean actually, meaning it was not providing the range. So therefore a lot of adjustment were happening. They saying mean is not the right methodology, right dispersion methodology to go. Why don't you look at some other options? So India adopted globally interquartile range is used. So to widen the bracket. But India instead went for 35th to 75th percentile. So I'll tell you what is the advantage of having a range vis-a-vis to arithmetic. Now what you have to do in step 1, put these margins, which you always do in any minimum to maximum values. This is what I'm telling, these are all statistics, no tax. Statistics, your 12th standard, 10th, 11th, CPT statistics. Or if you've forgotten, you can always go back, you try to arrange from minimal to maximum when it comes to range. Or even while calculating percentiles, we try to do in a minimum to maximum. So you arrange it in ascending order, the margins, which is what I have done here. So I've arranged these 7 margins in ascending order, minimum to maximum. Now, income tax says you can go for a range of 35th percentile and 65th percentile. So this is coming, and they have also given how to go about. So these computation mechanism, how to go about finding it is given in rule 10 CA. For 35th percentile, number of points in data set multiplied by 3500. We are talking about percentile. So number of points in data set, that is 7. 7 into 35%, 2.45. 65th percentile, similarly, 4.55. So therefore, now you remember the rule says this is not a whole number. Not a whole number. So therefore, the immediate whole number can be taken. The immediate whole number is the 3rd place. And here, the immediate whole number is 5th place. So therefore, go to 3rd place. 3rd place, 8.20 is there. Go to 5th place, 10.57 is there. So your range is between 8.20 and 10.57%. So your arm's length price can be anywhere between the margin between 8.20 and 10.57%. Let's look at an example. If your transfer price is 6%, is it within the range? You have charged 6% margin, but the range says it should be between 8.2 to 10.57. So therefore, this is not in range. I'll come back to you how that is. So therefore, this is not in, my transfer price is not equal to my arm's length price. Look here, my transfer price is 9%. Whether this falls within the arm's length price range, yes, I'll come between 8.2 to 10.57 within the range. So no adjustment. My transfer price is 10%. Does this come between the range 8.2 and 10? Yes, within the range. I don't need to worry. I'm happy. Now, the first question. Now, when I said my transfer price is 6%, is it within the range? No, not within the range, because I should have been anywhere between 8.2 and 10.5. Now, how do you do adjustment? Because my transfer price is 6%. How to do adjustment? For which they are saying, take the median. So what is the, how to find out median? Your half. So 7 is the data set. Half of 7 is 3.5. This is also not a whole number. So you go to the next immediate next place, which is 4th place. So your median is 9%. This is your 9%. Now they are saying median is 9%. So therefore adjustment will be 3%. Very interesting mathematics statistics session. I think I'm reliving all your CPT days, I guess. Nostalgia. I'll repeat again. So all you need to do is, just refresh your statistics knowledge. But these mechanisms are given under Rule 10CA, which is also there in your study material. You can look at it. But this is how the computation goes. If you have 7 comparables, because you should have at least 6 comparables for going for a range. So here there are 7 comparables. Now I have to put the operating profit margin in ascending order, minimum to maximum. Once I have done, I have to pick the range. The range is between 35th and 65th percentile. So 35th percentile, how will you find out? Total data set, number of companies, number of comparable data sets into 35%. 7 into 35, 2.45. 7 into 65, 4.55. So therefore, now I have, both are what? Both are unfortunately not a whole number. So immediate next. Now, how will I go and find out 2.45 here? Very difficult. So you go to this is what statistics, dispersion principle. You go to the immediate next. So after 2.45, what? Third. So third place. Similarly, 4.55 next was what? 5th place. So go and see what is there in third place. 8.20 is there. What is there in 5th place? 10.57 is there. So my range is 8.20 to 10.57. So this is the advantage range gives. It gives you a range. So therefore you can try to choose. So therefore you can, now you need to ensure that your transfer price is within this range. If it is within this range, for example, if your transfer price is 9, then absolutely no problem. It is within the range, no adjustment. I'm happy. Tax authority is happy. But if my transfer price is 6%, it is not within the range because I have charged less. Anything above 10.5, if it is 11%, very happy. Tax authorities are happy because you're charging more margin. But I'm charging only 6% margin. Now the tax authority is not happy because you are saying, look, the range is 8.2 to 10.57. Your transfer price is only 6%. So I'm going to make an adjustment. Now, how will you do an adjustment? Will you do 8.20 minus 6? Will you do 10.57 minus 6? This will create a lot of confusion. So what they have done is, if your transfer price is not in the range, then the arm's length price will be the median. Arm's length price will be the median if your transfer price is not in the arm's length price range. I repeat, if transfer price is not in the arm's length price range, then to make adjustment, your arm's length price will be the median. Median is what? Number of points into data set half, 50th. That's your median. So this is an odd number, 7. So therefore, 3.5. You go to the immediate next place, 4th place. So arm's length price as which is median is 9%. Your transfer price is 6%. Adjustment will have to be done for 3%. Till date, they have not asked any question on computation of interquartile range, but there is a very high possibility because this is very significant in terms of arriving. So therefore, you can expect a 6 marks question on these lines. So what I will do is, I also have one more variation. What if I have, we saw this as not a whole number. So what if there are even number of data sets? So I have next question where I have 20. And what if where there is a even number of data sets? So we will try to find out. In fact, I would want you guys to find out or anyway, we will do it together and find out whether the quartile range stands, how to find out the quartile range. So 35 percentile to 65th percentile is the range. That is, sorry, not quartile. 35th percentile to 65th percentile is the range that is given under Indian income tax. Many countries follow quartile range, which is 25 to 75. 25 to 75 gives me a broader range. So a lot of countries have 25 to 75. So imagine if it is 25 to 75 here, this thing may come from 6, you may never know, it may be 6 to 11.90. So it gives me more broader margin range. But India is very conservative. Indian tax authority says, no, I will not agree interquartile. They have instead said, choose anything between 35th to 65th percentile. So I have to find out the range and I have to ensure my transfer pricing falls within the range. If my transfer price does not fall within the range, then I have to find out the median. That median will be my arm's length price, and accordingly adjustment have to be made. So what I will do now is, please digest this. This is coming as part of Rule 10 CA. Should be there in your study material, but in terms of how to go about finding the 35th percentile, 65th percentile. But what we have done is pure statistics. Taking the data set, putting it to ascending to descending order, minimal to maximum, and then doing 35th, finding out 35th percentile and what is there in the 65th percentile, found out the range, and see whether my transfer price is fitting within the range. So let's take 15 minutes break. We'll reassemble at 8 p.m. Digest this. If you have any questions, please let me know. Like, yeah. All right. Welcome back. So we are in the final stages of closing of TP. There are a few other concepts which I wanted to share. But before that, just to reiterate on the range. So when where the data set comprises of 7 data points, so more than 6, then in such a scenario, you will have to arrange them in ascending order, and the 35th to 65th percentile has to be computed. So how to compute 75 into 7 into 35, that's your data point, number of data point, 765. So since these are not whole numbers, the value to be selected is the third value, the immediately next. For 4.5, the immediate next fifth value. In this case, the range between the third value and fifth value will be the benchmarking range. So if your transfer price should fall within this range. If it does not, then the median will act as the arm's length price to do the adjustment. Ambika asked a question, can you refer to module for meaning 35th? I don't know what does she mean by that. I don't know, Ambika, I don't know. What do you mean by refer to module? If you're referring to study module, yeah, the same thing is given here. Rule 10 CA8. So you will have to use the range when you have more than 6 data sets, and you can look here. Same thing, the lowest value in the data sets such that at least 35% of the values. However, if the number of values, the screen is visible, okay, perfect. So therefore, however, if the number of values that are equal to or less than is a whole number, then the 35th percentage shall be at. So this is if it's a whole number, I'll come to it. That is the 20. If it is not the whole number, then the closest value next to it will be treated. So again, what I did is pure statistics. So 35th to 65th percentage. Now, the next aspect, what I want to tell you, what we in the example we saw 7 data points, but what if it is 20 data points? Okay, sir, I mean in case of Resale, that is what we're going to do next. So where the data set comprises of 20 data points. So if we have 20 data points, so 20 into 35 will work out to 7, which is a whole number. Similarly, 20 into 65 works out to 13, which is also a whole number. So what they are saying is, in such a scenario, under the computation mechanism mentioned, and this is a rule 10 CA mechanism. The rule 10 CA says, when you have a whole number 7 and 13, if you have not a whole number, they say take the next value, third value, fifth value. But when you have a whole number, so you can have a whole number because it is 35 and 65 only when you have minimum 20 data, you will have because 10 you will not get whole. Anyway, 20 data points, you have a whole number 7, again 6, 13. But here, you cannot go directly to 7th data set or 13th data set. They are saying, take the mean of 7th and 8th value. Similarly, take the mean of 13th and 14th value. Same thing for median, where if you have 20 data points, the median will be the 10th data set. But they are saying, don't take that. Take 10th and 11th value median. Now, why are they doing this? I have no idea. There's no logic. The only logic you can see is they want to minimize the range as much as possible. That could be the reason for having this mean of 7th and 8th value mean. So mean will come when there is a whole. Mean will come when there is a whole number. So if it is not a whole, if it's a discrete number, then next value, next immediate. But if it is whole, they are saying mean of 7th and 8th, mean of 13th and 4th, mean of the next value and the value. And then you have to find. So I've given an example here. Quickly, we will try to run through this. So I have given you 20 data sets and I've given you profit or comparable uncontrolled prices given here. So this is for 20 data sets. 1 to 20 data prices there. Now we need to find out the range. Now range 35th percentile and 65th percentile. We all know that. If you go back to the rules, number of data points 20 and 35, 7, 13, but you have to not go for the 7th and 13th. You have to go for the value to be selected is mean of 7th and 8th. So you have to go for the mean of the 7th and 8th value. Now let's find out what is the mean of 7th and 8th value. One moment. Trying to remove the annotation. All right. Now, if you look here, the value to be selected is, so we've got this as a whole number, 7th and 13th for 20 data sets. But the rule says the value to be selected is mean of 7th and 8th. So let's go to 7th, which is 47 and 48. So you have to get the mean, 47 plus 48 divided by 2. Look here, 47 plus, look at the formula box. So therefore, range, one of the range here is 47 and a half. Now similarly for 65th percentile, it is 13th and 14th mean. So I go to 13th place. I got this price. So 14th I got this. I take an average of this. It comes to 48.75. So therefore, my arm's length price range will be 47.5 to 48.75. And same with regards to median, 10th, because 20 by 2 is 10. It says go for the mean 10 plus 11, mean of 10th and 11th. Now I go to 10th place. I go to 11th place, do the arithmetic mean, it comes to 48.4. So therefore, if my transfer price is 40, let's take this scenario. If my transfer price is 50, I don't need to worry because I am charging more than what the arm's length price is. So no adjustment, nil, no adjustment. Whereas if my transfer price, let's take, is 48, then I have to see whether I am in the range. Yes, within the range. That is, I am between 47.5 and 48.75. So therefore, nil adjustment. But what if my transfer price is only 47? If my transfer price is only 47, I am definitely not in the range. Now, how to find out how to do the adjustment? For that, you need to now need the median. So median will act as your arm's length price. We saw median is 10. So the range should be, the value that should be taken is, since the whole number, mean of 10th and 11th. So which is 48.4. So my arm's length price will be 48.4, and therefore adjustment will be made to the effect of 48.4 minus 1.4. This will be the adjustment. So so this is all you need to remember is some statistics formula and computation of range. So 7 data points, 20. If it is whole number, then you have to take the mean. If it is not a whole number, the percentile in the range, then you have to take the immediate next value. And median will be the arm's length price if the transfer price is not in the range. So this is the formula, and this is what India has adopted in order to have a range concept when you have multiple arm's length price. So just keep this in your mind. You may, because I have not seen any questions coming out on quartile range, or sorry, on range as yet, so you can expect it. Now, just to complete the cycle on the range, now, if I have only 5 data sets, I told you I need minimum 6 data sets. I need 6 data sets, 6 or above, 6 or above for range. But if I have only 4 data sets, go to this scenario. The KFC example, we had only 3 comparables, if you recollect. So therefore, in such a scenario, you cannot use range. But what they are instead giving you is, you can go for a, that is, I'll show you. When you don't have a range concept, then your transfer price, whatever is your transfer price, it should be within plus or minus 3%. So in the, if you recollect the example, 4% is what we saw in this thing, the example of McDonald's. So in that case, they are saying 4% plus or minus 3%, plus or minus 3% is allowed as a tolerable range. So up to plus or minus 3%. So from 4% plus 1 or 3%, 4 into minus 1 or 3% within that range. For example, it comes to say 3.5 to 5. And if your arm's length price is, you're within that, it is okay. Otherwise, you will lose out. So arithmetic mean concept will come when range is not there. So when range is not there, you will use arithmetic mean. And what they mean by arithmetic mean is plus or minus 3%. So your transfer price should be in the range of plus or minus 3% of your arm's length price, and arm's length price will be the arithmetic mean. So I'll to ensure you guys have clarity, I'll show you this. We'll do this so that you will get clarity. Look here. So this is our transfer price, 4%. Now you will have to add this 6 plus 4 plus 3 plus 2, 10, 13, 15. 15 divided by 4 works out to 3 point, I'm just doing a rough calculation, 3.9%. So my transfer price is 4%. My arithmetical mean comes to 3.9, which is my arm's length price. So therefore, since my transfer price is greater than my arm's length price, I don't need to do any adjustment. My transfer price 4%. I have 4 comparables. So I cannot use range because minimum 6 comparables is required. So I can do an arithmetic mean of the 4 comparables. The arm's length price works out to 3.9%. A, comparable A plus comparable B plus comparable C divided by 4. So 15 divided by 4 works out to 3.9%. So my transfer price margin is 4%. My arm's length price margin is 3.9%. So I should have charged 3.9%, but whereas I have charged 4%, since my transfer price is greater than my arm's length price margin, no adjustment. Got it? Now, if my transfer price is 3% only, arm's length price is 3.9%. So in this case, what will be the adjustment? 3.9% minus 3%. So 0.9% will be the adjustment, TP adjustment, TP primary adjustment. I would have done a primary adjustment to this effect. They're giving you one small benefit here. What benefit they're giving you is, if this 3% plus or minus 3%, that is 3% plus 1.03, 3% minus 1.03. So and if this works out to say it comes to 3.9% hypothetically, then no adjustment is required. So they're giving you a small range. So your transfer price plus or minus 3%. So they give, okay, no problem. If there is some variation, previously they gave 5% variation, but now the government only gives 3%. So this is notified by the government. The government says if your transfer price is plus or minus within 3%, and in that 3%, it fits into the arm's length price, then don't do any adjustment. I'll give you a way. This is a very little only, but still some small leeway that is being given. So this plus or minus 3% will come only when you don't use range. Okay. So when you don't use range, when you won't use range, when it is a profit split method, or when you have only less than 6 comparables, you will not use range. So when you don't use range, you will then have 4 or 5 comparables. You will do an arithmetic mean and then find out the arm's length price range. And an arm's length price, arithmetic mean will show you arm's length price. And that arm's length price has to be equal to transfer pricing. If it is not equal, that is your transfer pricing is less than your arm's length price, to that effect, adjustment has to be made. However, a small benefit is given. That is, if your transfer price, you do a plus or minus 3% in it, and if that works out to arm's length price, no problem, no adjustment. So they're giving you a small variation, plus or minus 3%. This is because very difficult to get exact comparables, exact function. So they, okay, 3 plus or minus here and there, 3% of your transfer price, I'll accept it. Plus or minus 3% of your transfer price. Keep that in mind. So plus or minus of your transfer price, you accept. So this is what the concept. So with this, we are completing the arm's length price range. Have any questions? All right. So we saw the methods. We also saw when you have multiple arithmetic price, then when to use range and when to use arithmetic mean to this thing. Now, with this, we are done with the concept of international transaction, concept of associated enterprise, and they have to be at arm's length price, and how to determine arm's length price through a most appropriate method. What are the most appropriate method? The government has determined 6 methods, and you can choose any of the 6 methods depending upon the transaction. And if you are using TNMM method or cup method, and you have multiple comparables, so multiple arm's length price, in that case you can use a range concept. The range will 35th percentile to 65th percentile. If the transfer price falls within that range, very good. If it doesn't fall, then median will be treated as your arm's length price to do the necessary adjustment. If you have less than 6 comparables where you cannot use range, then in such a scenario, you have to go for arithmetic mean. You have to do an arithmetic mean and find out whether your transfer price is equal to your arm's length price. One small benefit you will get is you will get a plus or minus 3%. This 3% will be notified by the government. They have now notified 3%. Previously, it was 5%. So if your transfer price is ASPAS, that is within the plus or minus 3%, and if you're able to fit into the ALP, then you can get away. So remember range, remember arithmetic mean, remember plus or minus 3%. So with this, we are done with primary adjustment. Now, this is another new concept which came from Finance Act 2017 called secondary adjustment. Now, I keep saying primary adjustment, primary adjustment. Now, I'll tell you what is primary adjustment. The primary adjustment, we also, if you recollect this example, the first session we did, where Samsung has a manufacturing in India, Samsung in India. So Samsung India buys raw materials for 200, sells mobile phone for 1000 to Samsung Brazil, which in turn sells it to its customers in Brazil. Now, Income Tax Department India says this 1000 is not the right price. Similar, comparable, uncontrolled Indian manufacturers charge 2000 rupees. So therefore, I am making an adjustment. So transfer pricing, primary adjustment is done for 1000 rupees. So increase. Total income gets increased by 1000 rupees. This is what we saw. So this is what we all saw in the so far. Now, what is secondary adjustment? The secondary adjustment is, see, you will now show that you have increased. This is for tax purposes. You have increased your income to 2000 and you pay the tax. Now, what government is saying is, let's try to close the cycle. How to close the cycle, complete the entire circle or the entire this thing. What you should have done, you should have actually got 2000 rupees, correct? In India, a similar, if you had you sold this finished product for 2000 rupees, your cash balance and the balance will also in profit would have shown 2000. But now your cash balance is showing only 1000, correct? Because that is what you have sold. And there is a transfer pricing adjustment. It's only a tax transfer pricing adjustment for 1000, for which tax is paid. But they are saying, no way. You should, your cash balance shows only 1000. Your cash should show 2000. You should have actually got in your bank account 2000. Foreign exchange should have come into India. Yes, you have paid tax, you have paid transfer pricing, all fine, good, primary adjustment. But actually speaking, the real value is 2000. That is what a similar uncontrolled manufacturer is charging. And in his bank balance, this 2000 will be there. He would have shown in his book, it will lie in his reserves. But whereas, even though we have done transfer pricing adjustment, where is the 1000 rupees? They are saying you have to bring it back to India. This is called secondary adjustment. If you don't bring it back to India, then they are saying, I will treat the 1000 rupees which is lying here, which should actually, Brazil should actually give. So ideally, what should happen is, Brazil should give this back to India, this 1000. Since it is not given, they are saying, I will treat this 1000 as advance, as a deemed loan given by Samsung India to Samsung Brazil, and I'm going to charge interest. And you should show that I'm going to give. So the secondary adjustment is the interest on the loan or advance, and for that you need to pay tax. So they are saying you bring back the amount. So this is again secondary adjustment is even globally, it is a new concept, because they said, okay, you pay transfer pricing tax, that is fine. But the country should get that money, because he should have charged 2000 to Samsung Brazil, but whereas he has not charged 2000, he has charged only 1000. I hope you're all with me. Anyways, sorry, I'll rub it right. Anyways, not coming. All right. So all they are saying is he should have charged 2,000, but he has charged only 1,000. Okay, for that we have made a primary adjustment, but then that does not stop it. They should bring back the money into India. So therefore, all they are trying to say is you should have brought back. So this is what Samsung India to Samsung Brazil. Initially, they sold a sale price of 1,000, but tax authority found out that the arm's length price works out to 2,000. The arm's length price works out to 2,000. So the taxpayer, yes, accepted it. I got it. I should have charged 2,000 because similar comparable uncontrolled company has done it. So this 1,000 rupees TP adjustment increase and necessary tax would be paid. The increase in S India profit by 1,000 primary adjustment does not address from the benefit obtained from retention of 1,000 by S Brazil. So this 1,000, even though it is shown in India profit, this money still lies in Brazil, Samsung Brazil. So therefore, under the secondary adjustment concept in 92C introduced by India, S India should bring back this 1,000 within a specified period of time. Should bring back within a specified period of time. Now, what is that specified period of time? So I'll tell that. But if it does not bring it, so within that specified under section 92C, they have specified the time through the rules. If that is not brought, then this 1,000 shall be considered as advance akin to a deemed loan given by S India to S Brazil, and interest shall be charged on the same. So they will treat it as a loan and notional interest will be charged. On that, the Indian S India has to pay tax. So this is called secondary adjustment, and this is becoming a very, very important area. Because why this is getting very important is, see, now a lot of times the transfer pricing assessment, as you all know, since you're all the aspiring chartered accountants, assessment happens after 2 years and all those things. So even assuming this adjustment is accepted, in India under FEMA regulations, once you have closed the books, very difficult to bring it. When many countries have foreign exchange regulations, even in India, you cannot change the financials of that assessment year. You would have done it, passed, everything passed. So therefore, there are a lot of concerns from a legal and regulatory perspective. And many countries has this, they say, why should we give this money? This is an adjustment made in your other country. So our foreign exchange regulation won't allow, there should be an invoice for it. There should be, if you are treating as a loan. So therefore, there are practical difficulties that is emerging from secondary adjustment. But anyways, be that as it may, the concept is this. If there is an adjustment, primary adjustment done, then just by paying taxes, the chapter is not closed. You should bring back the amount. If you don't bring back the amount, it is treated as a loan. Some countries actually treat this as dividend, deemed dividend. They treat it as an equity. But India treats it as an advance, as a loan. And they say within a certain period of time, you should bring back the adjusted amount. If you don't bring back, then we will levy interest on it. Now, these are the nitty-gritties. Within when should I bring? The time limit is within 90 days from the adjustment. That is 90 days from transfer pricing officer's order or assessment order. If you are suo motu making adjustment, there are situations where transfer during the filing return itself, taxpayers themselves do a primary adjustment, suo motu, very rare, but some taxpayers are doing it to avoid litigation and all those things. Because you normally do a benchmarking later at the time of filing, If you do a suo motu return, then within 90 days, you have to bring back. So you need to remember, if a transfer pricing officer's order is passed and there is a primary adjustment done and you have accepted it, you have not gone on an appeal. That is very important. You have accepted it, then that primary adjustment, 1,000 in our case, has to be brought back within 90 days. If you don't bring back, then interest, how will they compute the interest? What rate interest? Interest will be 1 year marginal cost of fund lending rate of SBA plus 325 basis point. Currently, I believe it is 7.9% plus 3.325 basis point. So 3.25. It comes to somewhere around 7.15%. Interest will be levied roughly around 11.15%. Because 1 year marginal cost of funding is, I think, 8%. 8%, let's keep for simplicity, plus 325 basis point. So 3.25. So 11.25% will be the interest levied. So on 1,000, 11.25%. 11.25% will be treated as your interest income. Ambika has asked the question whether is this loan a thin capitalization? No, this is not thin capitalization. Thin capitalization is where you give. I mean, where a capital is given by, where your parent company gives you, instead of capital, gives you as a loan and you pay interest. You pay interest. Here it is other way around. You are assuming as if you are given a deemed advance, because Samsung India should have sold it for 2,000, but Samsung India has sold it only for 1,000. So therefore, there is a 1,000 primary adjustment done. Government is saying it is not. You cannot stop with 1,000 adjustment. You should also bring back. You should also bring back the primary adjustment into India. Bring back the money into India is their contention. You say bring back the 1,000 rupees into India. So if you don't bring back, then the 1,000, the primary adjustment 1,000 will be treated as deemed advance given by Samsung India to Samsung Brazil. Interest rate will be marginal cost of SBA plus 325 basis points. I hope secondary adjustment is clear. So this is becoming a very controversial aspect. So let's do a quick practice problem on this. So if in fact, if at all they ask, this is how they may ask the exam for 6 marks. So let's see the question. The question is before your screen. The transfer pricing officer, while carrying out the TP assessment for assessment year 21-22, arrived at an arm's length rate interest of 4% on the loan obtained by Indian Associated Enterprise from its parent entity in Cyprus. The Indian Associated Enterprise had paid interest at 8%, amounting to 16 crores. So instead of 4% arm's length rate, they have paid 8% interest as transfer price. That is your loan of 8%. So accordingly, the TPO has made a primary adjustment to the tune of INR 8 crores. So 8 crores they have allowed, 8 crores disallowed. 8 crores disallowed under transfer pricing. Because you should have paid only 4% interest, you have paid 8%. So I will not take your interest expenses as 16 crores. I will only take 8 crores. So the balance 8 crores is a adjustment, is a TP adjustment. Now, the assessee, the AE1, has not gone on an appeal. So which means it has accepted it. You are required to explain whether any secondary adjustment to be made under section 92 what would be the answer if the assessee had opted to file before the CE? I hope you all got the question. The question is excess interest paid by associate enterprise to its parent, 8% interest. The transfer pricing officer found out that a similar benchmark interest is only 4%. So they have paid extra. So he has disallowed the balance payment. Now, having disallowed and that transfer pricing adjustment made, the assessee also, that is AE1, has also accepted it. So TP adjustment is 8 crores. Now tax will be levied on this. Now, whether secondary adjustment to be made? Yes. Secondary adjustment will have to be made. Whether any secondary adjustment to be made? Yes, because they have paid. So how much they have paid to the Cyprus entity? 16 crores. They should have only paid 8 crores. So before secondary adjustment was introduced, assessee will only pay tax, keep quiet, chapter over. But now after secondary adjustment, this 8 crores, which is unreasonably paid, that is, which is not at arm's length. Now, by virtue of secondary, this 8 crores has to be brought back. 8 crores has to be brought back to India. $8 crores TP adjustment. This is TP primary adjustment under section 92. Now, by virtue of 92 CE, secondary adjustment, 8 crores to be brought back within 3 months of the transfer pricing order or assessment order, within 3 months. Else, 8 crores will be treated as deemed advance given by Indian company to parent, and interest will be levied at SBI rate, which is 8% plus 325 basis point, 11.25%. So on this 8 crores, 11.25% will be treated as interest income. So primary adjustment 8 crores, secondary adjustment interest income, that is 8 crores into 11.25%, depending upon when the money is brought back. Number of months will be counted from the 3rd month violation. So this is called the secondary adjustment. Any doubt here? So therefore, whenever any primary adjustment is made, that money has to be brought back into India, else it will be treated as deemed adjustment. So answer to this question is, you are required to explain whether any secondary adjustment. Yes, secondary adjustment has to be made because assessee has accepted the adjustment, so he should bring back the money. Else, what are the consequences? Thankfully, the question is also here, the follow-up question. What are the consequences? Consequences are, he should bring back the money within 3 months, else interest will be levied. Income that the primary adjustment amount will be treated as a deemed advance or deemed loan. Accordingly, interest income will be charged at on 8 crores, 8%, whatever is the SBI rate plus 325 basis point. Now, there is one option available. This is an amendment introduced last year. What happened was, a lot of these assessees says, look, it is not possible for me to bring back the amount because under, let's take the Brazil example. Under Brazilian foreign exchange laws, I am not entitled to repatriate this money my foreign exchange regulations don't allow. So in that case, a lot of representation went to the department. The department came out with one option. They said, if you are not able to bring back, then do one thing. I will not pay this, I will not pay anything, but pay tax at 18%. So if you, so within 3 months, you have time. If you don't bring back, 4th month, you realize that you cannot bring this, Brazil is not accepting, then they are saying 8 crores into 11.25% into 1 month, whatever amount that comes, into 18% tax. The Indian company, Indian AE has to pay. If you pay, we will not bother you to bring this money. So concessional rate, it's kind of, pay. Ideally what government says is you bring back the money. But if you cannot bring back the money, regulatory or some even strategically, the parent is not allowing me to send this money back, then they are saying, okay, in that case, pay tax. Pay tax. So you can either pay within 3 months or 4th month, or whenever you are paying, the interest will accordingly come. So you have to pay tax at the rate. You have to watch out. It is only 18% plus necessary surcharge. May come to 12%, but the headline rate is 18%. So 18% is the rate mentioned in Rule 10 for secondary adjustment. So this is the consequences. 2 consequences. 1, bring back the money within 3 months, else interest will start ticking until the money is returned back. Option 2, you cannot return the money back for regulatory reasons or the parent is not allowing. Then you have to pay tax at 18% based on a similar computation. On the whenever you are paying the tax that month, up to that month, you have to compute a deemed interest and pay taxes. So this is the consequences. Just one other variation I've given. What would be your answer if the assessee had opted to file an appeal before CIT appeals? That is, the assessee is not accepting this 8 crores adjustment. He's saying, no, you are benchmarking wrongly. I don't know where did you get this 8%, 4% arm's length rate. This is wrong. Then if you go on an appeal, then secondary adjustment won't come. Secondary adjustment will come only when the matter is finalized, when you have accepted it. If you are going on appeal, the matter is still sub judice. So therefore, in that scenario, secondary adjustment won't trigger. All right. So this is to do with the secondary adjustment. This is a new concept, but one needs to be extremely careful. I have just few minutes left, so I've got few other concepts. Quickly, I'll run through them, and then we'll quickly take up the transfer pricing, the last set of multiple choice questions. So documentation. So now we are done with primary adjustment. We are done with secondary adjustment. So we are done with the practical aspects. Now we are coming to the procedural or compliance aspect. Now procedural is you have to maintain documents to prove that your transaction is at arm's length. So there's a contemporaneous document to be maintained. This is there in Rule 10D. You have to maintain the industry profile, transaction. So just like how you do your audits, where you need to maintain adequate documentation, you have to maintain adequate documentation. And then every year before filing a return of income, 1 month before, so which means 31st October, normally for transfer pricing, the due date is 30th November. So before 31st October, chartered accountant has to file Form 3CEB. So every taxpayer has to obtain a chartered accountant certificate in Form 3CEB, where the chartered accountant should ensure that or should certify that adequate transfer pricing documentation is made. And please understand one important point, this documentation is only if international transaction is above 1 crore. So if international transaction is only 50 lakhs, you don't need to maintain documentation. But TP will come. Form 3CEB will have to be filed. Transfer pricing will come. Even for 20 lakhs, transaction between my group enterprise, foreign enterprise, documentation not required, but TP will come. TP provisions will attract. That is, I have to still prove it is at arm's length. I have to file Form 3CEB. All those rest of things will be there. Only this contemporaneous documentation is not required. But normally speaking, when you deal with foreign parties, everybody will try to have a proper documentation. So, but this 1 crore is a very, very small amount, especially for multinational groups. So not very relevant. But just for exam's sake, they may try to ask you, what is the threshold limit for maintaining documentation? It is 1 crore. So now there are some penalties. So I'm not going to go through it. It's there in your module. Please have a look at it. That is, if you don't report your international transaction, you've done a transaction, you don't report, or you don't furnish Form 3CB from a chartered accountant, or you furnish, you don't furnish information when a transfer pricing officer or AO asks. So there are penalty given. So to discourage people from not maintaining document, or to ensure that people maintain adequate documentation to avoid penalty. So penalty provisions are very important. So I will not go through it. You can just have a look at it. Now, how assessment happens quickly. So we have done the arm's length price. We have maintained documentation. We have filed written off income, filed the Form 3CB. So this is the cycle. I'm going through the evolution. Everything is done. First, enter into transaction, find out my transfer price, find out my arm's length price, see whether I am at there. I filed the written off income. I filed the Form 3CB. Then what happens? Then assessing officer. Now you also have somebody called transfer pricing officer, who is akin to assessing officer. There are some scrutiny norms are prescribed. So since transfer pricing is a very niche area and requires in-depth analysis, as I mentioned to you, if you have seen the last three sessions, very little technical legal language, lot on business aspects. So the transfer pricing officer has to understand the business first, understand the comparables business, understand. So therefore, many times if you see in transfer pricing representation, not only chartered accountants or lawyers go, they also take the in-house technical persons, engineers, CEO, not necessarily the finance guys, to explain how the business runs, how a factory runs, what is that they do. Because all these things are relevant in order to arrive to understand what exactly the taxpayer is doing, so that you can find appropriate comparables. For this, lot of time takes. So hence, a new set of assessing officers called transfer pricing officer was set up. So transfer pricing officer will do all the study, and he will tell whether any adjustment to be made or not, and he will pass an order, and the assessing officer has to take that order into consideration, because he will check other non-TP matters. For example, 40A, 43B, rest of the section 17, 23, whatever is there, 37 expenses, the rest of the tax provisions, he will scrutinize. And once transfer pricing this thing is come, he will take that order, and assessing officer has to mandatorily give respect to the transfer pricing officer. He cannot say, no, TPO is wrong, I will do my own way. No, transfer pricing officer or transfer pricing officer's order is binding on the AU. Now, if you are not happy with the transfer pricing office, so once what happens, the TPO will pass an order, it will go to the AO. AO in such a situation will not pass an order. He will send you a draft order. So this is applicable only for TP and international transactions, mainly for transfer pricing. So he will send you a draft order. You can have a look at that draft order. If you're not happy with the draft, if you're happy with the draft order, you can tell the AO, I'm happy. Go ahead. If you're not happy, you can go on an appeal to TRP, Dispute Resolution Panel. Now, why this was introduced was, lot of taxpayers complained in India, transfer pricing litigation skyrocketed. Huge amount of transfer pricing litigation, because comparable companies, I will not accept this. This company is not there. Financials are not available. As I told you, very subjective. So transfer pricing, in fact, 2012-13, there is adjustment was made almost up to 4 billion US dollars. Adjustment, huge. Nowhere in the world so much of TP adjustment happened. India became a litigation hub for transfer pricing. This didn't go down well with foreign investors. They all complain saying there is no certainty. There's no tax certainty in India. India is a difficult place to do business. Every time litigation. So therefore, the multinational group complain. So in order to please them, in order to bring certainty, they got in a concept of dispute resolution panel. So once a draft order is there, you can appeal to DRP. The advantage in DRP is within 9 months, the DRP has to accept or reject the transfer pricing order. So so timeline is very quick. So he can, once that he gets the draft order, within 9 months from the draft order, he needs to pass his order, the DRP's order. Now, who is a DRP? DRP comprises of 3 tax officers. So it has 3 tax officers. Basically, why 3? So that you will get multiple perspective and you will try to get a fair judgment. So they will then say, yes, the TPO is right, or no, TPO is wrong. If you are not still happy with the DRP's order, you can go to appeal to ICAI. So basically, the advantage of DRP is you don't need to go to CAT appeals. But if you prefer, you have an option. You can either go for DRP or you can go for CAT appeals. The advantage with DRP is timeline, 9 months. With CAT appeals, you never know when you will get your appeal because of huge. You may get after 2 years, then he has to pass, then you have to go to ICAI. But with DRP, the advantage is he has to pass within 9 months, so you can quickly go to ICAI and your entire litigation period will be cut short. So you will get quick. You get to know. You don't need to know a case. Pada hua hai, pata nahi kab adjustment hoga nahi hoga. So you don't need to. The advantage of DRP is that. So I will not. So this is the assessment procedure. Now what happened was, unfortunately in India, the DRP, since they are all tax officers, they are highly biased towards their own, and they cannot go against their own colleague who is part of the same. So DRP is actually, unfortunately, but that's the ground reality, has been a miserable failure. Because every DRP order that goes, it is like your GST AAR. Everything that goes is in favor of the taxpayer. So invariably, appeals went on to ICAI. So it was not a dispute resolution. It was only dispute exacerbation or enhancement. It was a waste in between. They could have directly gone to ICAI. So therefore, again, a lot of criticism came about saying, what's the point in having DRP when it is not a resolution? It is not coming out with any, it's only favoring the tax administrators. So every time we have to go to ICAI, and ICAI was flooded with a lot of transfer pricing cases. So therefore, some dispute prevention mechanisms were introduced. One is your safe harbor rules. As the name says, safe harbor. What is a safe harbor? A ship in a safe waters. So come to the safe harbors. So it will, there's no question of getting sunk further. So the government, in order to ensure that, dispute prevention, please, I'm using the word prevention. Resolution is once a dispute is there, how to resolve it. Go to DRP, go to ICAI, go to High Court, go to Supreme Court. Here they are trying to even prevent the dispute from happening. So how you can prevent this? They said we introduce something called safe harbor rules. Now what is safe harbor rules? They have not for all, for certain international transactions, for certain international transactions with limits, some threshold. You can look at this. There is no limit specific. Safe harbor is not notified for assessment year 21-22 or for assessment year 21-22. It is only notified for assessment year 2021. That is for certain transaction like intra-group, manufacturing of some auto components. So there are some transactions specified in Rule 10 TE. You can look at Rule 10 TE, Rule 10 TA, TB, TC. There are some. I'm not going to go through those transactions for want of time. So they have specified the margin. So if you are into intra-group software development, that is, you remember the Beta example, Beta India giving to Beta Inc. software development, and your turnover is less than say 200 crores, you should have a margin of 14%. So the margins are given before itself, rather than taking a comparable, trying to find out, going through range. You will say no, A is not a comparable. Tax officer will say B is a comparable. You will say B is not a comparable. You will say C is a comparable. Tax officer says C is not a comparable. So to avoid all these issues, the government came with a menu card. Menu card saying, you are doing this transaction, this is the margin. This transaction, this is our margin. So therefore, you can avoid the disputes by saying, okay, the government notifies 14% for software development. I will also charge 14%. Government says manufacturing components margin will be 3%. I will ensure that my margin is 3%. So you have to file a form for that. I am opting for safe harbor rules. No problem. Assessing officer will not harass you. Just go through it. He say, okay, fine. So safe harbor is basically dispute prevention. So you have to be undergoing certain transaction. This is not for all the transactions. Government has notified only for certain transactions and certain thresholds. If you come under that menu card and you say you're doing this, you have to charge 14% margin, government notifies, you have charged that, no worries, no assessment, no DRP, no ITAT, no High Court, no Supreme Court. Life is easy, tax certainty is happy, your parent is also happy, working capital, your amount won't get stuck in litigation. You don't need to engage lawyers, chartered accountants to fight. Life will go on, you can keep moving. Now, only criticism for safe harbor is they are saying the margins that is notified are very high. It is not in line with the market. So this is one disadvantage of safe harbor. But if you're sure my margin is only 10%, I've charged it right, you don't need to opt for safe harbor. You can still go, you have to prove that your margin is 10%. So this is safe harbor mechanism. Now, quickly, one more dispute prevention is advanced pricing arrangement. This has become a huge hit in India because under advanced pricing arrangement, so safe harbor is one mechanism. You can either go for safe harbor or you can ask the government, look, come, let's get into an agreement and you go through all my transactions, let's fix a margin. Let's fix a percentage. Let's not every year you pick up for scrutiny, I go for appeal. Every year this is becoming a nightmare. I want certainty. So this is again a global concept, advanced pricing arrangement or agreement. It's an agreement between taxpayer and tax authority on the pricing of future intercompany transactions. So normally for 5 years, they'll get into a advanced pricing agreement. So for the first time, you have to apply and tell all your transactions, and government and you will finally say, okay, 15%. So you both will enter into an agreement that my margin will be 15% to my associated enterprise. So if you can for 5 years, after 5 years, you need to renew, show that you're doing the same. So till 5 years, you don't need to worry. Government is not going to bother you because you have an agreement. So this is again a prevention. So here the advantage vis-a-vis to safe harbor is you can always negotiate the margins. You have to showcase what is the transaction you're doing, why you deserve this margin, why you need to give only this margin. Assessing officer, the tax authority will do their homework. You will say, I'm going to charge only 12%. Government will first say, I don't charge 20%. Finally, you both will end up at 15%. So there is a tax certainty by virtue of advanced pricing arrangement. One interesting aspect in advanced pricing arrangement is you can also do a rollback. That is, at the optional, you can also go back up to 4 years. So normally, as you mentioned, I mentioned it future, but Indian advanced pricing arrangement also gives an option to go back up to 4 years to avoid ongoing litigations. For example, assessment year 21-22 we are in. You can go and say my 18, 19, 19, 20 also. Can you please go back and give a retroactive? Yes, that is possible. That is one advantage which APA gives. So you need to know advanced pricing arrangement is an arrangement for future transactions, but also by virtue of rollback, you will up to 4 years, you can go back and you can agree for this same margin. So this is the advantage advanced pricing arrangement gives: certainty, avoidance of audit, efficient management of transfer pricing issues, fewer complaints cost. Disadvantage: only one simple disadvantage I will tell you. In COVID times, nobody would have anticipated. I would have said 15% 2 years back. So 5 years agreement, 15%. COVID, heavy loss, global loss. I'm suffering, my parents suffering, but I've gone into an agreement. So I cannot reduce this 15%. I still have to pay, give a margin of 15%. Even though overall market margin may be only 2% because of COVID. Heavy loss, heavy debt. But this is a disadvantage advanced pricing arrangement has. COVID is a classic example. Because you already decide and agree. Now you cannot come back and say, no, COVID, I will not give 15%. Then it is violation of agreement. Heavy penalty will attract. So this is one disadvantage of advanced pricing arrangement. So with this, I think we are done with the major concepts. What I'll quickly do is, we will just finish the rest of the multiple choice question. Won't take more than 3 to 5 minutes. So that we'll be done with the transfer pricing. 11th, we were here. So I want you guys just contribute for the next 5 minutes. Wake up. I know you're hungry, but just let's finish it off. When there are more than one ALP, all right, let's do one thing. We will stop here. So we will do the 10 multiple choice question in the next class on Saturday before I start equalization levy. So until then, what I would suggest is you can just go through whatever we have done on transfer pricing. So the major concepts that we have discussed in transfer pricing are international transaction, associated enterprise should be at arm's length price. Arm's length price has 6 methods. Major methods are CUP and TNMM. CUP uses comparable transactions. TNMM uses operating margin. If you have multiple arm's length price, then you need to go for range, that is quartile range. We saw this quartile range. If you have less than 6 comparable, then you can use arithmetical mean and ensure that your transfer pricing is plus or minus 3%. Next, we saw secondary adjustment. Primary adjustment is your first adjustment. Secondary adjustment is you have to bring back the money into India, whatever amount that has been sent outside, adjusted. If you don't bring back, that will be treated as a deemed loan, and accordingly, interest will be charged as a secondary adjustment. Then we saw what are the procedural aspects to be done. Penalty will trigger if you don't maintain documentation, don't furnish chartered accountant certificate, are not maintaining appropriate documents, then the transfer pricing officer or tax officer can invoke penalty. So then we saw about dispute resolution panel, which is if you are not satisfied with the transfer pricing officer's order, you can go on an appeal to DRP, and then from DRP you can go to ITAT. In Indian government also, seeing the litigations happening in TP, introduced 2 dispute prevention mechanism: safe harbor and APA. Safe harbor is a menu card already given rates. If you comply with it, with those menu card rates, then you are in safe harbor. Government will not harass you or keep asking for adjustment. Advanced pricing arrangement, on the other hand, is you don't need to follow the menu card. It is more like what is that rate you want to finalize. So you get onto an agreement with the government, and both of you will sit, decide, negotiate, finalize the margin rate, arm's length margin rate, and that will be for a period of 5 years. One unique feature of India's APA is you can go to rollback up to 4 years. So even the past assessment years which are open, which are finished, which are on appeal, all those things can be rectified by virtue of the rollback provisions. So a big advantage APA has been very successful in India. It has reduced a lot of transfer pricing issues because taxpayer and tax administration have sat together, negotiated, and arrived at a where both of them have agreed to a margin. But only disadvantage you have in APA is future estimation. Business, it's all business driven. Like COVID, you can completely, go out of the picture, but still you have to agree with the margin which you have agreed under the APA. So these are the pitfalls of advanced pricing arrangement. So with this, we will stop for today. 6 to 10 marks, easy for transfer pricing. Please don't miss it out. Please also go through the next 1 or 2 days so that you are on track. Go through the past questions. We did a lot of past exam questions only. You will understand at the end of the day, if it's a computation of margin, only math. But these are the other questions they may ask. But as I mentioned to you, low-hanging fruit. Please take the fruit and enjoy it. We will see in the next class for equalization levy on Saturday. Thank you very much. Good night to you. If you have any questions, please note it down. You can put it or we can discuss in the next class. Good night.